Conventional versus FHA. Which one actually saves you more? The honest answer is that it depends on your credit, your down payment, and how long you will keep the loan. Here is a clear side-by-side way to decide. Subscribe to Money House Media for more educational clarity. First, what they are. Conventional loans follow the rulebook set by Fannie Mae and Freddie Mac. Fannie Mae, also called the Federal National Mortgage Association, and Freddie Mac, also called the Federal Home Loan Mortgage Corporation, are government-sponsored enterprises. They buy conforming mortgages from lenders, set baseline guidelines for credit, debt-to-income, and loan-to-value, and bundle loans into mortgage-backed securities. That keeps money flowing so lenders can make new loans. Most conforming loans meet Fannie and Freddie limits. Larger jumbo loans are still conventional but non-conforming and are priced by the lender. FHA loans are insured by the Federal Housing Administration. They are popular because they are more forgiving on credit and debt to income, and the minimum down payment can be as low as 3.5% for a primary residence. Mortgage insurance here is called MIP, which stands for Mortgage Insurance Premium. It has two parts. There is an upfront fee that is often financed, and there is an annual MIP billed monthly. How the insurance works. PMI on a conventional loan protects the lender if you default and is usually paid monthly. The cost depends on your credit score and loan-to-value. You can often cancel it around 80% loan-to-value, or earlier with a new appraisal if the value has risen. Many loans auto-cancel near 78% if you are on time. MIP on an FHA loan includes an upfront fee, typically 1.75%, plus an annual MIP added to your payment. With at least 10% down, the annual MIP can fall off after 11 years. With less than 10% down, it usually lasts for the life of the loan, unless you refinance to a conventional loan later. Let us compare simple monthly examples on a $500,000 home. These are illustrations. Your real numbers will depend on rates, credit, and lender pricing. Property taxes vary by location, so add your own tax amount at the end. Conventional example with 5% down. The loan amount is $475,000, 30-year fixed at 6.75%, principal and interest about $3,081 per month, PMI placeholder at 0.60% annually, about $238 per month, homeowner's insurance placeholder about $200 per month. This totals roughly $3,518 per month before property taxes. FHA example with 3.5% down, base loan $482,500, finance the 1.75% upfront MIP, which makes the new loan about $490,944. 30-year fixed at 6.50%, principal and interest about $3,103 per month, annual MIP at about 0.55%, around $221 per month, homeowner's insurance about $200 per month. This totals roughly $3,524 per month before property taxes. Result: on this profile, the monthly totals are very close, and that is normal. Which one wins for you depends on the mix of interest rate and insurance cost, and on your path to removing that insurance. Now, a tougher credit conventional example to show when FHA might win. Keep the same 5% down, but assume a higher interest rate and a higher PMI factor. 30-year fixed at 7.125%, and PMI at about 1.10% annually. Principal and interest about $3,200. PMI about $435. Add $200 for homeowner's insurance. That is roughly $3,836 per month before property taxes. In this case, the FHA example we just covered would likely be cheaper month to month. What else matters besides the monthly payment? Property use. FHA is for primary residences. Conventional also allows second homes and investments. Property condition. Conventional can be more flexible on condition. FHA has additional safety and habitability checks, loan limits and cash to close. Both programs have limits that vary by county. Compare total cash to close, not just the rate. Exit plan. With conventional plan to remove PMI around 80% loan to value. With FHA plan a refinance to conventional once you have the equity and credit to drop MIP. How to choose in under 1 hour. Ask 2 or 3 lenders for written loan estimates on both options on the same day. Compare rate and APR. Compare total lender fees and points or credits. Review the monthly payment broken out by principal and interest, PMI or MIP, and homeowner's insurance. Confirm the cash to close, then plan a 2 to 5 year horizon. If a refinance is likely, include estimated costs and the month you would break even. Bottom line, stronger credit and 5 to 20% down, usually favors conventional long-term because PMI can be removed. Lower credit, smaller down payment, or higher debt to income may favor FHA now, with the option to refinance later if it saves you money. You have this. Subscribe to Money House Media and grab the free first-time buyer checklist in the description so you can plug in your real numbers and see which path saves you more. Disclaimer: educational purposes only and not financial advice. Programs and rates change. Consult a licensed loan officer.